Palantir is down 80% from its highs. If you know me, I have bashed people on YouTube who went to the moon for Palantir and they were absolutely 1,000,000% wrong. But I want you guys to remember that just because it's fallen 80, 90% and has proven me right, I'm not going to sit there and take it out on the stock. It's fallen 80, 90%. Now's the time to take a look at it. My past videos, I talked about Palantir being interesting, probably around $5 a share. But we're close now. Now it's time to take a deeper dive into seeing what I'm willing to pay for Palantir. So let's use our software, 8-Pillar software. If you're already a subscriber to the software, please open it up and follow along. It makes a lot more sense as you're doing it. 8 Pillars, PLTR, Palantir Technologies, $9 a share. A nice rebound off the low of $6.44 a share. So not as terrible as I thought. 52-week high is $29, but folks, just wait a second. All-time high, $39 a share. Ooh, that's rough. So it's about I exaggerated. I said 80, 90% drop. It's more like a 77 to 78% drop. Now, really quick before we get in the numbers, here's how important it is for you to understand. The great thing about this channel is we give people the tools to be able to avoid big drops, 80, 90, 100% losses. Remember, if you have a stock that loses 80%, your money has to go up 5 times more, which could take 15 or 20 years to happen. That is why I teach this process. Well, let's go into this company. It's a $17.5 billion company. Revenue last year of 1.65. Oh, and they lost $500 million last year. But they did have free cash flow. So, 8 pillars. Very first one, we want the 5-year PE to be under 22.5. Spoiler alert, doesn't even exist. Why? Because in the last 5 years, the company has not made money. Okay. Pillar number 2, we want to see revenue growth over the last 5 years. So we go to our income statement in our software, and let's go to the annual level. So there is big growth. We don't have 5 years of data. $595 million to $1.5 billion. Pillar number 3, we want net income growth of the previous 5 years. Again, we don't have 5 years of data because it's Palantir, but they lost $580 million 4 years ago. Last year, they only lost $520 million. And the previous 12 months, it was even less than that. So kudos to Palantir. They are growing like crazy though. So the losses should be considered as part of a greater scheme for getting more growth. Pillar number 4, we want shares outstanding staying the same or decreasing over the last 5 years. 4 years ago, they had 716 million shares outstanding. They now have 1.92 billion. Over double. Now, for those of you out there who probably in Europe have a YouTube channel and try to justify it by saying the stock price, the market cap goes up when you issue more shares, you're wrong. And this isn't a stock split, guys. This is literally the company diluting you as an owner. So if you owned shares 5 years ago, the good news is you're now getting a smaller and smaller piece of the losses. But when the company starts making money, you're going to get a smaller and smaller piece of the profits. Share dilution sucks. It hurts you as an owner. It is splitting against your own will, dividing the revenue and profit amongst more people. So again, this is a problem. Pillar number 5, do we have adequate cash flow to cover the long-term liabilities? Well, guys, unfortunately, we don't have cash for the last 5 years. So all debt is bad debt at those levels. Does that mean it's really true? No. Our 8-pillar system is best with companies that have been around for a while who have revenue and profit. This company has no profit. I don't know what to say about that. So pillars number 7 and 8 have to do with free cash flow. So let's go to our annual free cash flow statement. The good news is they finally had free cash flow in the previous 1 year, $320 million, which is way better than the losses they had that were growing along the way. And in our software, we add our free cash flow line because free cash flow is cash from operations less your capital expenditures. But the cash flow statement does not have this line. We added it to our software for our users to be able to view this number and not have to do the math. We also have the 8 pillars tab. This does all the math for you, but spoiler alert, we need 5 years of data in our software. So there's not enough data, but let's go show you a real business, software business that makes money. Microsoft, for example. Here's the 8 pillars all shown, check marks and X's. So for those of you who are new to our channel, in our videos, you'll be able to see the actual data when they have 5 years of data. Now, this brings up a point that I want to make. Palantir is exciting. It's growing. It's got tons of potential, and there's a lot of hype behind it. Guys, be cautious on these. Where there's a lot of hype can be a lot of fall. The company was $39 a share, and now it's $9. It got as low as $6. So what do we do from here? Just because a company is losing money doesn't mean it's a bad investment. If you can pay cheap enough for it and you see the potential for profit, there's a lot of greatness that can come from that. So let's go look at the analysts out there. Well, first off, revenue. Well, there aren't many analysts covering it. They don't go very far, but they are expected to do $3.28 billion in a couple of years. So there's good growth here. High 20% growth. How about earnings per share? They're actually expected to make some money this year, 16 cents a share, and get up and double that in the next 2 or 3 years. So there is some profit growth as well. They are expected to make money this year. So let's go to our stock analyzer tool. Our stock analyzer tool was extremely and has been extremely popular with our users. And the reason being is every investment is the present value of all future cash flow. We don't know the future. We can only make assumptions for it. Okay. The stock analyzer tool asks you to make these assumptions, and it tells you what you should pay for the stock based on those assumptions. Now, I usually do a 10-year analysis, but in this situation, I'm only going to do 5-year analysis. Why? Because we really don't have even analyst expectations, and I want to make sure I can make my money and make it good and move on. So, revenue growth. It was high 20%. So I'm going to start with 20, 25, and 30. Now, you might be saying, well, Paul, you just said it was going to be high 20s. Yeah, guys, but we want to be conservative, and analysts tend to be wrong in the longer term. So I'm going to be more conservative than 30%. I'm going to go to 20, and I'm going to put high side of where the analysts are. Profit margin. In this situation, 16% per share on 2 billion shares, about $320 million. And they're expected to do revenue of about $3 billion. So it's about 10%. So I'm going to go, and by the way, it's a software business. Software businesses tend to have high margin. So I'm actually going to stick with 10% as my low. I'm going to go 15 for my middle and 20% for my high. Same for the free cash flow margin, because free cash flow and profit should be the same over long periods of time. For the PE and price to free cash flow, there are 2 reasons you should assign a higher multiple of PE and price to free cash flow for any company. Those 2 reasons are a moat or high growth potential. This one has the high growth potential. I don't know if it's necessarily a moat or not. You have to understand more about the business to understand what they really do that makes them a moat. But they do have a high revenue potential growth rate. So for that, I'm willing to give a higher PE. I'm going to do 17, 20, and 23 for both PE and price of free cash flow. Now, for desired annual return, the market will give you 9 or 10% over long periods of time. I usually put 12.5% for a bigger company, but this company's small with a lot more risk. We don't know the future. It still isn't making money. So I'm going to put in 15% desired annual return. That gives me a higher margin of safety. Let's hit the analyze button. So guys, remember what I said before. I said before that it was pretty interesting on $5. We have a low price of 2, a high of 8, and a middle price of 445 or 450. So I'm probably there. Now with our software, you can set a price target, add it to your watch list right here at 805. If you want to see my consistency, 1 year ago, I made the prediction that I sat there and said, I'm interested in Palantir on $5 a share. There was a YouTuber out there pumping it up, saying I was wrong and didn't understand it. My reaction's above. Go click on it. You'll see the consistency from here on out.